How does a global energy titan lose 15% of its oil production in a volatile conflict zone, yet, still manage to increase its quarterly net income by an astounding 41%?
I mean, it sounds like a math error, doesn't it? If a massive piece of the machine just breaks off, the profits are supposed to crater.
Right, exactly.
But in the highest tiers of global energy, the physics of corporate finance operate on a completely different level.
And that contradiction is exactly what we're unpacking for you today. Welcome to this deep dive. Our mission here is to look way beyond the massive corporate numbers and really understand the mechanics of how a true global titan is currently navigating intense geopolitical supply shocks, wild market demands, and the ongoing energy transition.
All while generating billions in cash, by the way.
Right, billions. We are zeroing in on the first quarter 2026 financial and operational results from the global energy giant TotalEnergies. And just so you know exactly where we're getting this, every single insight, number, and strategic pivot we discuss today comes directly from their official Q1 2026 press release and financial statements.
Yeah, published on April 29, 2026.
Exactly. So we aren't speculating or, reading tea leaves here.
No, not at all. We are taking a dense 20-page corporate financial diagnostic and translating it into the actual mechanics of their global strategy.
Okay, let's unpack this. Because before we can even begin to talk about specific physical assets like deepwater oil platforms or transition gas or, offshore wind farms, we really need to understand the absolute scale of the money moving through this company right now.
Yeah, the scale is just immense.
It really acts as a kind of armor. Like in the first quarter of 2026, TotalEnergies reported an adjusted net income of $5.4 billion.
Which is huge.
Yeah, that's a 41% increase from the previous quarter. And they generated $8.6 billion in cash flow.
And, they are aggressively returning a significant portion of that capital to their shareholders.
Right.
They announced a 5.9% increase in their interim dividend, bringing it to 90 € per share. Plus, the board authorized up to $1.5 billion in share buybacks.
Just for the second quarter alone, right?
Exactly, just for the second quarter.
Wow. And the structural health metrics are just as staggering. I mean, their return on equity is sitting at 14.4%, and their gearing ratio is sitting comfortably at 15.5%.
Which really shows extreme discipline with their debt levels.
It does. But this brings me right back to that opening paradox. I look at this company's financials like a high-end off-road vehicle. It's got this incredibly sophisticated shock absorber system.
They call it their integrated portfolio.
Right, operating across oil, gas, and power. But, I mean, a 41% jump in profit while losing massive production. I need you to break down the mechanics of how that shock absorber actually functions in the real world.
Well, what's fascinating here is how the different parts of their business hedge against each other. The integrated model is designed so that when one segment takes a hit, another segment is positioned to capture the upside of the broader market environment.
Okay, make that real for me.
Think about the macro conditions this quarter. Brent crude oil hit $81.1 a barrel. Now, normally, a spike in raw material costs puts incredible pressure on a company's balance sheet.
Sure.
For instance, their working capital increased by $5.1 billion this quarter.
Wait, let me stop you there, because that working capital number is huge. So that $5.1 billion isn't just like normal business seasonality. Half of that is directly linked to the reality of $81 oil, right?
Exactly. It's the literal cost of holding inventory.
It just costs them far more cash to keep the tanks full and the system pressurized.
That is the exact mechanism. Higher oil prices mean higher operational friction and inventory costs. For a non-integrated company, that's a crisis.
Right, they'd be bleeding cash.
But because TotalEnergies pulls the oil out of the ground, refines it, trades it, and sells the final power, that massive cash flow generated by selling their own produced oil at $81 a barrel entirely offsets that $5.1 billion increase in working capital.
Oh, wow. So they just absorb it.
Yeah, the integrated model absorbs the shock of those higher operational costs. It essentially converts the friction into profit.
But, I mean, that financial cushion is entirely dependent on physical oil actually flowing out of the ground, which brings us to the physical reality of what they do, the exploration and production segment, E&P.
Right, the bedrock of it all.
Because when we talk about a shock to the system, the geopolitical situation in the Middle East last quarter wasn't just friction, it was a brick wall.
Yeah, the top line number they report for E&P is that total hydrocarbon production averaged 2.553 million barrels of oil equivalent per day.
Which is a crazy amount of oil.
It is. And if you look at the year-over-year chart, that number is completely flat, just stable.
But stable hides the turbulence underneath, right? Because they took a massive hit. There was a 4% decline in total production entirely due to the conflict in the Middle East.
Yeah, we're talking about operational shutdowns in Qatar, Iraq, and UAE offshore facilities.
Right, and by April, that represented about 360,000 barrels a day of shut-in production. That is roughly 15% of the company's total global oil and gas production just taken offline.
Just going.
Yeah. Couple that with a 2% natural decline of their aging fields, and you've got a 6% total downward pressure on production. Logistically, for a global producer, that is an absolute supply nightmare.
Viewed objectively, it is a severe regional disruption. But this is where we see the strategy of staggered global diversification at work.
Okay, how so?
Well, that 6% loss was perfectly offset. They gained 4% organic growth from new project startups spinning up at the exact right time, plus another 2% increase simply due to higher availability and uptime of their existing production facilities worldwide.
So they didn't just get lucky with the timing, did they?
No, definitely not.
They intentionally stagger the development of these massive projects so that when a mature region like the Middle East experiences a sudden shock, they have new high-yield assets ready to immediately fill the void.
Exactly.
Because I'm looking at the list here. The Lapa Southwest and Mero projects coming online in the deep waters of Brazil, the Mabruk onshore oil field in Libya, and the Begonia project in Angola. It's a deliberate geographical counterweight.
It is entirely deliberate. They are constantly shuffling the geological deck to ensure they aren't, overly reliant on any single political or regulatory environment.
Right, that makes sense.
While the Middle East was facing shutdowns, their E&P segment still delivered an adjusted net operating income of $2.6 billion. And they're already seeding the next generation of counterweights.
Like the new discoveries.
Yeah, they just announced 2 new hydrocarbon discoveries of around 100 million barrels of oil on the Moho field in the Republic of the Congo.
It's an aggressive footprint. And it's not just new drilling, it's corporate maneuvering, too. Like in the UK, they completed a major merger of their upstream assets with NEO-NEG-XT to create the country's largest oil and gas producer.
Huge move.
Yeah, and they signed technical cooperation agreements in Kuwait and exploration agreements in Turkey. If one hemisphere faces a crisis, the global production just shifts to another.
Which is the bedrock of their entire operation.
Yeah.
That steady flow of physical crude is what funds everything else.
Which means we need to talk about where that funding is going, their transition fuel, integrated LNG, liquefied natural gas.
Right.
If oil is this steady foundational baseline that they balance across the globe, LNG seems to be where they are actively surfing some incredibly wild market swings.
Oh, absolutely. The market dynamics for LNG are wildly different from crude right now. The integrated LNG segment generated an adjusted net operating income of $1.3 billion and a massive cash flow of $1.8 billion.
That's serious cash.
It is. The underlying driver here is production scale. They achieved a 12% quarter-to-quarter increase in LNG production, strongly supported by output from Australia, the United States, and Malaysia.
They are definitely scaling up the infrastructure. I see they fully resumed construction on the massive Mozambique LNG project, and they signed a 20-year preliminary offtake agreement for 2 million tons per year from the Alaska LNG project.
Great.
But looking at the data, there is a massive disconnect that I really need you to explain. Their LNG production jumped 12%, but their overall LNG sales volume was essentially flat. It only increased by 1%.
Yeah, it looks strange at first glance.
Why on earth isn't a 12% jump in production translating to a massive jump in sales volume? Are they just like sitting on the gas?
No. That disconnect is actually the hallmark of a highly sophisticated trading operation.
Okay.
The profit engine in the LNG segment isn't about pushing maximum volume out the door as fast as possible. It's about capturing the volatility of the spot market. TotalEnergies operates a massive global trading arm.
So they're playing the market.
Exactly. When you see production jump 12%, but sales volume remain flat, it tells you they're utilizing their storage and shipping logistics to strategically manage when and where those cargoes are delivered.
Oh, it's like they aren't just selling the cargo, they're operating a global air traffic control system for gas.
That's a great way to put it.
Instead of locking everything into immediate delivery, they're floating these massive tankers and rerouting them mid-ocean to whichever continent is suddenly willing to pay a premium that week.
You've captured the exact dynamic. If Europe experiences a sudden cold snap, or Asia sees an industrial surge, TotalEnergies has the logistical flexibility to divert the ships to capture that premium pricing.
Wow.
But they balance that high-wire trading act with long-term baseline stability. That 20-year agreement in Alaska you mentioned,
Yeah.
that locks in future guaranteed revenue.
Yeah.
It's a dual-pronged strategy: secure long-term agreements to pay the bills and use the trading desk to play the volatile spot market for massive short-term profits. It's how they plan to maintain long-term dominance in the global gas market.
And that structural dominance brings us to the most future-facing part of this report. We've gone from the bedrock of crude oil through the trading volatility of LNG, and now we step fully into the future, the integrated power segment.
Right.
This is where we watch a traditional oil major actively attempting to transform into a modern electricity provider.
And we were watching that transformation happen at incredible speed.
Huh.
The integrated power segment delivered an adjusted net operating income of $0.5 billion this quarter.
Not bad.
And the physical footprint of that power generation is expanding rapidly. Their gross installed renewable power generation capacity reached 35.6 gigawatts.
Just to put that scale in perspective for you listening, they commissioned 8 gigawatts of renewable capacity in just the last 12 months alone.
It's a massive build-out. And beyond pure renewables, they are aggressively expanding their traditional flexible power portfolio in Europe.
Like the EPH deal.
Yeah, they completed a 50% acquisition of a flexible power generation portfolio from EPH, which immediately gives them strategic generation assets across the UK, Italy, the Netherlands, and France.
Okay, but this is where I need us to look really closely at the mechanism of their strategy, because there is a glaring contradiction in this report regarding their green energy.
Go on.
TotalEnergies is highlighting this massive milestone of adding 8 gigawatts of renewable capacity. They're clearly proud of the scale. But in the exact same quarter, they reached an agreement with U.S. federal authorities to completely relinquish their offshore wind concessions.
They did.
These are leases they just won in 2022. They handed them back in exchange for a $928 million retrocession of lease fees. And on top of that, they sold a 50% stake in an 800-megawatt German battery storage project. It looks like they are bragging about green energy in the headline while quietly backing away from renewables in the footnotes.
It looks like a retreat, I'll give you that. But if we connect this to the bigger picture, it's actually a profound industry shift. What you're seeing is TotalEnergies treating green energy exactly like they treat fossil fuels. For a long time, energy majors were acquiring renewable assets just to build scale, to get a foothold, and honestly, to show the market they were serious about the transition.
Right, the PR angle.
Exactly. The operating logic was build it at all costs. But that era is over. TotalEnergies is now hyper-focused on a stated objective, generating positive free cash flow in the integrated power segment by 2027.
Ah, so they're no longer treating green assets as a PR exercise or a loss leader. They're treating electrons as a pure commodity. If a wind farm isn't going to turn a hard profit, they cap it, just like they would an unprofitable oil well.
That is the exact aha moment of this quarter's report.
Yeah.
Walking away from those U.S. wind leases and getting nearly $1 billion back is a display of ruthless financial discipline.
It really is.
The economic realities for U.S. offshore wind have drastically changed since 2022. Massive supply chain bottlenecks, soaring inflation, and high interest rates have destroyed the initial financial models. TotalEnergies looked at the updated math and realized the margins no longer supported their 2027 cash flow targets. They cut their losses and walked away.
Makes total business sense.
Yeah, and the same logic dictates selling half the German battery project. It frees up capital to deploy elsewhere.
Which explains the EPH power plant acquisition in Europe. They only want to play where the margins are robust and predictable. By acquiring flexible gas power plants, they're accelerating their gas-to-power integration strategy.
Right.
They use their own natural gas to ensure their European power generation can spin up instantly when the grid needs it, which is highly profitable.
Precisely. They are enforcing the exact same margin discipline on green electrons that they've historically enforced on crude oil.
That discipline really ties into the final piece of the operational puzzle here, downstream. This is the physical processing of all these fuels, the refining and chemicals, and crucially, the environmental footprint of this entire global operation.
Downstream was a beast this quarter.
It really was, because the downstream segment was an absolute powerhouse. They delivered a massive $1.9 billion in adjusted net operating income. That is up 60% from the previous quarter.
That 60% jump isn't magic either. It is entirely driven by physical operational excellence. Globally, their refinery utilization rates hit 92%.
Wow.
Yeah, up from 84% the previous quarter.
Now, they did have a significant hurdle. There was an incident at their Essator site in the Middle East on April 8th. It affected 3 units and triggered a shutdown as a safety precaution.
It was a serious incident, but their operational recovery was incredibly swift. The units that weren't damaged were safely restarted by April 14th, bringing the refinery back to an operating capacity of 230,000 barrels a day.
That's fast.
And looking at the broader picture, aside from that specific incident, their global refining network had 0 major turnarounds or maintenance periods in the first quarter.
And the mechanism there is simple. When refineries run flawlessly without stopping for maintenance, they just print cash. Because they were operating at 92% capacity, they were perfectly positioned to capture the exceptional European refining margins that spiked in March.
Exactly.
It connects directly to the pump. When you see fuel prices fluctuating due to high demand, companies that can refine crude oil efficiently and reliably capture the spread between the cost of crude and the high price of the refined product. That operational efficiency generated that $1.9 billion income figure.
But the operational efficiency story gets even more interesting when you look at their environmental metrics.
Right, because this is the other thing that completely surprised me. You have refineries running hot at 92%, you have stable global oil production replacing Middle East losses, and you have a 12% jump in LNG production. And yet, their environmental metrics improved dramatically. Scope 1 and 2 emissions, which is the direct climate footprint of their actual operated facilities, dropped 6%. Year on year.
It's impressive.
And even more shockingly, their methane emissions plummeted an impressive 33% year on year. The only way that math works without cutting production is if they fundamentally change the plumbing of their facilities.
You've hit on the exact operational shift. That 33% reduction in methane comes almost entirely from targeted structural reductions in flaring and fugitive emissions at their E&P facility.
Really?
Yeah, for decades across the industry, flaring, which is burning off the excess natural gas that comes up with the oil, was just considered an unavoidable cost of doing business.
But now, through better infrastructure and microscopic leak monitoring, they are keeping that gas in the pipes.
Exactly.
It's a perfect example of how aggressive environmental targets and pure corporate profit aren't always enemies. By fixing the leaks and stopping the flaring, they have less waste, a significantly smaller climate footprint, and literally more natural gas product to sell into that highly profitable LNG trading network we talked about earlier.
The environmental goal and the financial mechanism perfectly aligned.
We've covered a massive amount of ground today. For you listening, why should you care about a 20-page financial document from a European energy company? Well, because TotalEnergies' Q1 2026 report isn't just a spreadsheet, it is a real-time health check on the resilience of the global economy.
It really is.
It shows us exactly how insulated major energy conglomerates are from regional crises. I mean, they lost 15% of their Middle East production, and through staggered global assets and a perfectly tuned shock absorber of an integrated business model, their income still jumped 41%. It also shows us that the energy transition has entered a new, ruthless phase. The era of PR greenwashing is over. They are treating green power as a pure commodity, walking away from bad wind deals, and demanding positive cash flow by 2027.
Which leaves us with a critical structural question to consider as we watch this industry evolve over the next decade. Right now, TotalEnergies is utilizing the massive, exceptional margins from traditional oil refining and volatile gas trading to fund its gas-to-power and renewable ambitions.
Right.
It is a perfectly balanced, highly profitable transition.
Yeah.
But what happens to this integrated model when the scale finally tips? What happens when renewable electrons become the core product of the global grid, rather than the side project being heavily subsidized by the massive cash flows of fossil fuels?
That's the big unknown.
Can the financial shock absorbers handle that permanent structural shift without the cushion of $80 oil?
That is the multi-billion-dollar question, isn't it? The financial machinery is working flawlessly today, but the long-term prognosis of the global energy grid is still wonderfully, terrifyingly complex. Thank you for joining us on this deep dive into the source material. Keep questioning the data, look for the mechanics behind the headlines, and we'll
catch you next time.